And in the entire 50 years of the COMEX, we have never seen the house so long. I mean, when we say long, obviously, we mean on the bullish side of they're expecting a higher price against the blinkered speculators. Now, the extraordinary backwardations that we witnessed at the delivery point for the September, remember we recorded the end of September, just going into delivery at that point, and at the delivery point for the September silver contract, which then fed into an unprecedented exchange for physical disconnect, i.e. the difference between what was happening inside the casino and what was happening in the real world. It's then moved into the December contract. We've never seen such a condition before. It telegraphed to us that the final COMEX-driven capitulation point on September the 1st, which was, we'd already said at the time, at 17.5, that already we'd said that had to be the bottom for silver. And it turned out to be the bottom. However, gold futures became susceptible to really another month of follow-through automated spec selling. Now, normally, you would see gold and silver moving in tandem. We saw this divergence. We saw this scramble. We saw silver rising and gold still coming down. And this risk-free arbitrage opportunity assisted in countering this massive accrual of automated speculator sellers who had, for the entire third quarter, tick for tick, naked short sold literally thousands of tons of undeliverable silver contracts into this rising dollar. Now, while it's not unusual, and we've seen this before, it's not unusual to evidence the COMEX tail wagging the physical dog, where backwardations, we've talked about them before, where the price of the futures market is below the price of the spot market, against the cash physical market, they can coexist for extended periods of time. COMEX-driven backwardations to reach these unprecedented extremes. Remember, we were mind blown by the extent of them. It was a step too far for the greedy casino operators. And to be clear, this fresh competition is agnostic to price. These guys are not saying we want a higher silver price. They're simply capitalizing on the divergences in the silver market. But by closing this arbitrage door before the house can bring the register on this herd of speculators, this competition becomes very effective in draining the chips out of the casino, paper chips, ultimately raising the support floor, which is really what we've been seeing. And it's important to understand that while this predatory trade objective is not to raise the silver price, simply capitalizing on this $1,000 per contract risk-free arbitrage bucket. I couldn't believe it when we said it's $1,000, guys. It's there for the taking. All you have to do is come in and just take it. And what this has done is to impose some fresh, healthy competition against the house. And obviously we've been reporting that this arbitrable disconnect potentially sets up we talked about this, an enveloping physical horn, the GATA enveloping physical horn, to trigger a physically driven rally that cannot be contained inside SLV. In fact, with far less opportunity to cash settle SLV shorts with this competition in the house, trying to discount silver futures to cash settle SLV shorts will drive backwardations, which will be slammed shut. So this is totally, I mean, again, it's not been realized yet by the speculators, but they will note the change of behavior at some point. So slamming the door on insider covering into a fast contracting window to cover 1,800 tons of SLV shorts. I mean, unbelievable when you think about the scale of 1,800 tons. And now that the sharks are swimming inside the casino, the potential for also triggering a nickel-like short squeeze entirely on the cards. It was never factored in. And as this structural imbalance attracts more players, the incentive to force that nickel-like short squeeze becomes extremely and increasingly likely. Now, global silver buyers understand why silver is grossly underpriced. and that the backwardations are ultimately setting up the trigger for a tsunami of bid-only short covering. It's inevitable. We talked about it last time. We've seen a couple of triggers of it. What is invisible to the led by the nose, how hedge fund herd racing from dollar pillar to dollar post, is that the silver futures are now in the Nun Club crosshairs, actively hunting for structural weakness between the casino and the global markets. This is not a siloed Hunt Brothers scenario that the house can call in. In the larger picture, looking at gold, geopolitically driven safe haven physical demand has been totally glossed over. It really blows most people's minds. They can't believe with some of the threats that are going on here that gold hasn't reacted. Now there's a reason for that, because there's a PSYOPs operation in place. And so it's been glossed over. And during this paper-driven third quarter, COMEX-driven action, we've seen that. Yet the very large physical demands and large premiums over spot that we've been reporting have largely missed the mainstream media. Into a rising dollar, gold priced in all other currencies has been very, very strong. Physical gold, that is. And Bloomberg, for example, reported, I think, $44 per ounce premiums in Shanghai. However, these premiums had exceeded $50 per ounce ahead of Golden Week starting this week, and prompting credible reports that the import licenses in China will be brought forward. Well, that's going to suck an awful lot of physical gold back out of the market to fulfill these huge, to actually bring that price back into par. Now, and that means raising the price. Now, ultimately, we've got to understand, people have to understand there's only one supply of available physical gold. People think of it in dollar terms as the only price. No matter which fiat currency is priced again, it's being actively drawn down into multiple jurisdictions and currencies, which in turn is tightening gold supply priced in dollars too. The last time we evidenced anything close to such a bullish house structure was the 2008 upside inflection point. And as was seen in 2008, we can once again expect safe haven gold to rise alongside safe haven dollar inflows, because it's actually the tail stops wagging the dog and the dog starts wagging the tail. And liquidity providers also report the strongest physical market since 2008. You can't ignore this stuff, evidencing off the scale strong German, Asian and Chinese gold demand, with the premiums over spot the largest this year and increasing. And this will keep insiders exposed to the physical market one-to-one long against the spec sellers a hell of a lot quicker than they would have liked. So bottom line, following the heavy third quarter, we can expect a dip-mized market to return into the very tight for supply physical market in gold and silver during this quarter.